In less than 3 years, Meta spent a whopping $36 billion on Metaverse projects, yet they've only sold 20,000 headsets. They fired thousands of employees and took on debt. Their peers, like Apple and Google, ignored the Metaverse entirely and saw exponential growth. So how did such a rich company waste $36 billion? To answer that question, today we will examine this fascinating business case study that offers valuable insights into modern corporate strategy, innovation, and risk management. We'll break it down through our 5-step framework. First, we'll explore the glory days of Facebook or Meta, whichever name you prefer. Then we'll identify the turning point where everything changed. Next, we'll dig deep into the why and how this happened. After that, we'll analyze the fallout, and finally we'll discuss the lessons learned. Let's start with the glory days. Facebook had a glorious history. They disrupted social media with a new platform. Their stock price exploded. They were one of the most valuable companies. They had a young, energetic CEO who seemed invincible. But then something changed. Several scandals shook the company. People called them a monopoly. Competitors like TikTok took over. Investors began demanding a new growth engine. So what exactly is the Metaverse? In simple terms, it's a collection of virtual worlds where people can interact with each other using avatars. Zuckerberg announced his move to the Metaverse in October 2021 at a keynote speech. He said that Facebook was more than a social media company. It was a company building the Metaverse. There are several types of metaverses. The top ones include Roblox, Minecraft, Fortnite, Second Life, and the Sandbox. Most of them were built in the last decade by programmers and entrepreneurs who wanted to create immersive online experiences. Zuckerberg decided he wanted one too. His metaverse would be called Horizon Worlds. He said his vision was ambitious. He wanted to build a virtual economy where people could earn money, making content or selling digital goods. He envisioned a place where people could work, play, socialize, shop, learn, and more. He claimed the metaverse would create hundreds of billions of dollars of value, and so he embarked on a buying spree. He bought companies left and right. He bought Beat Saber, a VR rhythm game, for $1.25 billion. He bought Giphy, a GIF search engine, for $400 million. He bought Within, a VR fitness app, for $125 million. He bought Instagram, but that was before the metaverse, so it didn't count. At first, investors cheered. They loved his vision and ambition. They thought the metaverse was the future. But the more he spent, the more they questioned him. Analysts said he was spending too much. Critics said he was wasting money on a fantasy world. Competitors said he was running scared because he couldn't beat TikTok. Still, he pressed on. He kept buying companies and firing employees. He laid off 11,000 workers in November 2022. That was 13% of his workforce. He kept buying companies and going into debt. In February 2023, he took on $10 billion of debt. And still, he kept buying companies. He bought Phased, a virtual reality sports company. He bought Ref Appeal, a computer vision software company. He bought Woo, a virtual reality social networking app. Then something strange happened. His stock price collapsed. It fell from $370 in March 2021 to $180 in March 2023. That was a 50 drop. In fact, it was the biggest wipeout in US corporate history. His rivals recovered. Apple thrived with $18 trillion in revenue. Google thrived with $288 billion in revenue. Microsoft thrived with $290 billion in revenue. But Meta kept losing money on the metaverse. So far, they've lost $36 billion and counting, with an estimate lose of $75 billion by 2025. So the glory days ended when investors demanded a new growth engine. Now let's analyze the turning point. Facebook faced several scandals throughout its history. There was the Cambridge Analytica scandal, where they shared user data without permission. There was the fake news scandal, where they spread misinformation. There was the privacy scandal, where they collected data without notice. There was the antitrust scandal, where they crushed competition. But none of these scandals hurt them as much as the TikTok challenge. TikTok was a new app that made people dance. At first, it seemed harmless, just another social media craze. But soon, it became a cultural phenomenon. By January 2020, TikTok reached 1 billion downloads. By April 2020, TikTok reached 100 million daily active users. By December 2021, TikTok reached 1 billion monthly active users. And by August 2023, TikTok reached 150 million daily active users. That's 4 times the size of Facebook's daily active users. At first, Mark Zuckerberg ignored TikTok. He thought it was just a fad. But as TikTok grew, he panicked. He knew he had to do something to stop them, so he launched a TikTok clone called Lasso. But Lasso failed. He bought a TikTok clone called Snackable. But Snackable failed. He launched a TikTok clone called Reels, and Reels failed. To make matters worse, his own apps were leaking users to TikTok. Instagram lost 2 million, while WhatsApp lost 1 million daily active users to TikTok. Facebook lost 10 million daily active users to TikTok. That was a disaster. His entire empire was bleeding users to his greatest rival. So he had to pivot. He had to find a new growth engine. In late 2021, he found it. He found an app called Spaceland. Spaceland was a virtual reality game where people could socialize. Zuckerberg loved the idea. He offered to buy the app for $2.3 billion. The owners refused, so he bought a competitor called Beat Saber and used their technology to create his own version of Spaceland. That's how the Metaverse was born. Next, let's dive into the how and why. Facebook was already a mature platform. Its growth was stagnating. It needed a new growth engine. But instead of innovating within their existing business, they tried to innovate outside their existing business. They didn't try to fix social media. They didn't try to improve the user experience. They didn't try to launch a new feature. They tried to launch a completely new product. And that product was risky. Virtual reality is a risky market. Only 32 million people use virtual reality. It's also a capital-intensive market. You need expensive equipment to enter this market. Most importantly, it's a competitive market. They weren't the only ones building a metaverse. There was Roblox with 200 million monthly active users. There was Minecraft with 140 million monthly active users. There was Fortnite with 400 million registered users. So why did they enter the metaverse anyway? Well, there are 2 possible explanations. The first explanation is that they truly believed in the metaverse. They thought it was the future of the internet. They thought it was a $1 trillion opportunity. If that's true, then maybe it wasn't such a bad investment after all. Maybe it's just a matter of time until they succeed. The second explanation is that they entered the metaverse to escape their existing business. Their existing business was under attack from regulators, competitors, and activists. They were facing antitrust lawsuits, privacy lawsuits, content moderation lawsuits, ad boycott lawsuits. They were losing influence to TikTok. They were losing popularity to TikTok. They were losing users to TikTok. So they abandoned ship and moved to a new frontier. Regardless of the reason, they bet big. They bet $36 billion on the metaverse so far. They've spent $10 billion on acquisitions, $26 billion on capital expenditures, but those investments haven't paid off. Their headset is a flop. They've only sold 20,000 units. Their content is a flop. They've only attracted 300,000 creators. Their community is a flop. They've only attracted 30 million monthly active users. What's worse, their finances are a flop. Their revenue has fallen from $116 billion in 2021 to $114 billion in 2022. Their profit has fallen from $23 billion to $6 billion. In fact, the metaverse is burning cash. It burned $10 billion in 2022 and $13 billion in 2023. At this rate, it'll burn $16 billion in 2024. That means it'll eat up their entire profit. So how did things get so bad? Well, the answer is simple. They expanded into a risky market without a clear path to profitability. Next, let's analyze the fallout. The metaverse failure has several ripple effects. First, their stock price collapsed. It fell from $370 in March 2021 to $180 in March 2023. Second, their debt load increased. They took on $10 billion of debt to fund the metaverse, but now that the metaverse is failing, they'll have trouble paying that debt. Third, their user base declined. Only 30 million people use the metaverse. That's less than 10% of their total user base. Fourth, their profit. And now their profit is declining every year. Finally, their reputation is tarnished. They're known as the laughing stock of Silicon Valley. They're seen as the poster child for tech hubris. After all the hype and hoopla, all they have to show for it is a pile of losses. So what can we learn from this? Several important lessons. First, don't underestimate the power of incumbency. Facebook was already a mature platform. Its growth was stagnating. It needed a new growth engine. But instead of innovating within their existing business, they tried to innovate outside their existing business. They didn't try to fix social media. They didn't try to improve the user experience. They didn't try to launch a new feature. They tried to launch a completely new product, and that product was risky. Second, don't follow the crowd. Just because everyone is investing in AI doesn't mean you should invest in AI. You should only invest in AI if it makes financial sense for your business. In this case, virtual reality was not a natural extension of Facebook's core business. It was a completely new market with new technologies and new competitors. Third, don't ignore the competition. Facebook was naive to think that they could build a metaverse without competing with Roblox, Minecraft, and Fortnite. These companies had millions of users and billions of dollars in revenue. But Facebook was overconfident. They thought they could crush their competition just like they crushed Instagram and WhatsApp, but they underestimated the power of incumbency. Finally, don't panic. When Facebook panicked about TikTok, they made a series of bad decisions. They launched Lasso, which was a flop. They bought Snackable, which was a flop. They launched Reels, which was a partial success. If they had stayed calm and focused on their core business, they wouldn't have wasted billions of dollars. What do you think? Are they just unlucky, or did they make avoidable mistakes?